Hi everybody. In 1959, an Indian family started selling American innerwear to US military soldiers in Philippines. The soldiers liked it. Then the locals liked it too. Looking at this, that innerwear brand, which goes by the name Jockey International, gave the exclusive rights to manufacture and sell the Jockey products to that family, but with the restriction that they cannot enter any new business. 35 years later, that same family bought Jockey to India. They started a small company in 1994. They were given the exclusive rights to sell the Jockey products in India and nearby region. That company got listed in the Indian Stock Exchange in 2007 at 360 per share. And by 2022, that share was worth more than 54,000. The stock returned more than 150x in 15 years, and it was one of the highest wealth creators in the Indian listed equities. This is the story of Page Industries. The question is, how can a company that does not own a brand it is selling and that cannot enter freely into any other business became one of the greatest wealth creation stories in the Indian stock market? Is there any specific event that changed the entire future of this business, and what are the lessons that we can learn from this case study? By the end of this video, we will have the answers to all the three questions, and more importantly, we will have the framework that will help us think about any quality business. So let's start. Page Industries was incorporated in 1994 by Genomal family. It does not own a Jockey brand but got the exclusive rights to manufacture, market and distribute Jockey branded products in India and several neighboring countries. In exchange for this exclusivity, Page pays Jockey International a royalty of approximately 5% of its net sales every year. Before we talk about what Page Industries did, we need to understand the world it walked into. In early 1990s, the innerwear market in India was mostly unorganized. If you walked into a typical general store and asked for innerwear, the shopkeeper would pull out a stack of white briefs, no brand, no packaging, no quality consistency. You bought it by weight or by quantity. The organized branded market barely existed. Some brands existed like Rupa and Lux, but they were positioned at the value end of the market. So the innerwear market had three defining characteristics. One, it was dominated by the unbranded commodity products. Two, the consumer had no aspirational connect with innerwear. It was purchased made on price. And three, the retailer treated innerwear as low priority category with low margins and low footfalls. But the Genomals were not looking at what the market was, they were looking at what the market was about to become. India just gone through an economic liberalization in 1991, and for the first time, Indians were exposed to the global brands. A generation was coming up that had aspirations that their parents did not have and was willing to pay more for something that they felt premium and trustworthy. That gap between what the Indian consumers were becoming and what the Indian innerwear market was offering was the opportunity, and Genomals had exactly what was needed to fill that gap. Jockey, a globally trusted brand with 60 years of heritage. So the question was not whether the opportunity existed, the question was how to build a premium brand that never existed, how to convince an Indian consumer to pay 2 to 3 times more for underwear, and how to get retailer to display it on their shops. The answer was the three things that Page did better than anyone else. Firstly, unlike most apparel businesses which outsource production, Page manufactures 70 to 80% of its products from its own factories. This gives Page a complete control over quality. Every pair of Jockey sold is made under the same roof, with the same material and to the same standard. Consistency is one of the hardest problems in any consumer-facing business, and Page solved it by keeping the manufacturing in-house. Secondly, Jockey is available in over 66,000 retail outlets across India. This distribution network was built over 25 years. It took decades in building relationships, service quality, and selling through performance to earn trust with the retailers. And retailers in turn gave Jockey a prime shelf space, which means more sales. This became a reinforcing cycle. Any competitor cannot replicate this distribution depth in 3 to 5 years. And lastly, Page did not enter a branded market. It created the branded innerwear category from scratch. It focused on how the product was packaged, how the product was displayed in the stores, how it was advertised, and what price the consumers will be willing to pay for it. By the time competitor understood what was happening, Jockey already owned a premium innerwear space in the consumer's mind. These three advantages, in-house manufacturing, distribution depth, and category creation, combined with globally recognized brand, gave Page a competitive advantage. But behind this, there is one event that made all of the above possible. In 2010, Jockey International renewed Page's license, but not in a way they normally do. Jockey International's standard practice is to renew the license every 5-year period. 5 years is enough time to run a business, but not enough to build one. A licensee operating on a 5-year rolling window cannot invest heavily on manufacturing because they do not know if they still have the license after 5 years. They cannot build deep distribution network, and they cannot launch multi-year brand campaigns. In 2010, Jockey International gave Page Industries a 20-year extension, four times their standard practice. Why? Because Page had earned it. Genomal family had not diversified into any other business. They had not cut quality to improve margins. They had not damaged the brand. They had not expanded into any other geographies without Jockey's approval. This discipline of the family gave them the opportunity of a 20-year extension that no other licensee of any other countries has. Subsequently, that license got extended till 2040. Now with the license running until 2040, Page's management could now think in decades, not in years. They could invest heavily in their manufacturing units. They could invest in technology to improve working capital management. They could hire people and build institutional knowledge. This advantage generated strong cash flows from the business. Instead of diversifying, acquiring and expanding businesses into areas not related to the core business as CCD did, Page did two things. They distributed half of the profits to the shareholders as dividends and reinvested the remaining half back into the core business. This capital allocation discipline allowed the business to grow its revenue at around 30% CAGR for the last 15 years. Earnings grew at around 32% CAGR. Return on capital stayed between 50 to 70% consistently, and company never issued fresh capital nor carried any debt. And that is how Page Industries became one of the greatest wealth creators in the Indian stock market. That brings me to the 3 key lessons that we can learn from this case study. Lesson number 1. The most powerful advantage in the licensed franchise is not the brand, it is the trust of the licensor. And it is the behavior that matters, not negotiation. Page Industries did not negotiate its way into a 20-year license. It was produced by a 15 years of behavior, disciplined, focused, maintaining quality and growing the brand. So in a licensed business, history of renewals matters. Lesson number 2. The promoter who says no is worth more than the promoter who says yes. Page Industries could enter new business, expand into multi-year retail, and accept international licensing of any other brands. Each of these could be framed as a logical extension, but management said no to all of it because they understood their advantages existed only inside the innerwear category. So the most important quality of a capital allocator is not the ability to identify a good opportunities, it is the ability to walk away from them. And lesson number 3, a great business rewards patience. Page Industries share price increased from rupees 360 in 2007 to rupees 54,000 in 2022. But there were several bumps during this journey. In 2008, after the financial crisis, markets fell by 60%. In 2011 and 2012, stock went through a period of stagnation. In 2016, stock corrected sharply as demonetization disrupted consumer spending. But none of these points matter because business itself was not broken. So in a genuine business, timing in the market is the strategy for the investors. Now, here is the practical framework that you can take from this case study. First, when analyzing any licensed or franchised business, always look at the history of license renewal, not just the current license term. If the license is short and had not been extended, that is the structural risk. And second, when evaluating promoters' capital allocation quality, do not just listen what they say. Look at what they have done. Open the annual reports of last 10 years and list every acquisition. List all the time they have raised equity. A promoter who has consistently said no to the unrelated business diversification, balance sheet leverage, and equity dilution over a decade has demonstrated capital allocation discipline. Genomal family started with one idea and executed it with discipline. That idea, applied for 30 years, turned 360 rupees into more than 54,000. And that brings me to the end of this video. I hope this video was valuable to you. If it was, please like this video and subscribe to this channel for more such investment case studies. Thank you so much for watching. I will see you in the next one.